Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore. And today we are starting a two-part series which deals with the BEPS Action Plan 4, which was issued some time back by the OECD. So in part 1 of this video, we will look at what is this action plan all about, what is the genesis of this, and what this problem, how it has been tackled by the OECD by giving a specific recommendation to address this particular problem. Now, this BEPS Action Plan number 4 basically deals with limiting or restricting the base erosion, which is triggered on account of deduction of interest and similar financial payments. We will see all of that. Let us see and look at the context of what this is all about. Now, as we know that a particular entity, let's say for this entity, an entity can be funded either through the debt funding or the equity funding. Now, the manner in which an entity is being funded, that is whether by a debt or by equity, it has significant impact on the taxable profit of the entity. Why so? Because we know that in most jurisdictions, the interest which you pay on this debt funding is generally tax deductible. So interest expense will be allowed mostly as a deduction in your income tax computation. Contrary to that, when an entity pays dividend to the equity shareholders on the equity contribution which they have made, that dividend on equity instrument, that is not tax deductible. And therefore, as we all know, generally the debt is considered, relatively speaking, as a more tax efficient method of financing the equity, financing the entity rather than equity, right? Because higher level of debt invariably will lead to lower taxable income. Now, this is something which we know, but what problem this creates? So the question what we are trying to deal with is what issues this creates. If an entity, let's say, want to have a disproportionate debt on its capital structure, what problem it creates? And is more specifically, if there is a group situation when there are multiple entities across various jurisdictions. So just to set that context, let us assume that you have a scenario where you have an ultimate parent entity which is based in country A. And then this ultimate parent entity has a subsidiary S1 in country B. And this country B happens to be a high tax jurisdiction. Thereby meaning that here the tax rates are high compared to what you have perhaps in country A. Now, as we know, since money is fungible and mobile, many of these MNEs, the multinational enterprises, they try to achieve a specific favorable tax result by manipulating or adjusting the level of debt across the entire group. So, by using the level of debt in the various jurisdictions, they try to reduce their overall tax expenses. Now, this creates a problem from an international tax perspective. And various research studies have established that these MNE groups, generally, they multiply the level of debt at individual group entity level through the mechanism of intra-group financing. So, for example, it is possible that country A, here the interest rate is low. So, at 6% interest rate, this ultimate parent entity raises funds from a third party independent financier, and then the same money is lent to a subsidiary, let us say at 12% interest rate. Now, for this entity, when they pay 12% interest, this generally, if there is no precaution taken and if there are no rules around interest deductibility, then the entire 12% of the interest will be tax deductible in the hands of this as well. But they need to pay here, the ultimate parent entity need to pay only 6%. Now, it is possible that in this country, country A, the interest income is either not subjected to tax or subjected to low rates of tax. And therefore, if you look at the overall situation here, you at the one hand, you are getting 6% interest rate funding, and in lieu of that, you are passing it on at 12%. This entity gets the deduction at 12%, and here, whatever the interest income is being paid, that is either not taxed or taxed at a very low rate because of the tax regulations applicable in country A. And therefore, this creates a problem from the international taxation perspective. As I said, this position is accomplished by M&E groups, say by way of funding the subsidiary, funding this subsidiary in a high tax jurisdiction by infusing debt rather than equity. So rather than using equity, they are actually using debt and claiming interest deduction in that high tax jurisdiction. This is the way the M&Es try to get benefit out of the various tax laws applicable to the various jurisdictions. And therefore, M&Es, because of these kind of a structuring, these M&Es are able to claim excessive deduction of interest in high tax jurisdiction like country B in our example, and then they shift the profits to low tax jurisdiction. Why? Because here, country A in our example happens to be relatively low tax jurisdiction, and therefore the 12% which is allowed as a deduction here is pushed to country A, and this 12% income which they are earning is either not subject to any tax or low rates of tax. What it leads to? This situation results in what is called base erosion and profit shifting. What do you mean by that? That's the whole concept of BEPS. Now, in the scenario which I portrayed, because let us say the taxable income of S1 without the interest deduction was 100. Now, if you give a tax deduction of 12% of that 100 rupees, then the taxable income of in country B is only 88 rupees. And therefore, the base on which the tax is levied in country B is reduced from 100 to 88. And therefore, to the extent of 12 rupees, there is a base erosion happening in country B. And this 12 rupees is being shifted to profit shifting. Profit shifting has happened to a low tax jurisdiction. This is in the sum and substance of what the meaning of base erosion and profit shifting is. So in our example, base erosion is happening in country B and profit shifting is happening in country A. This country A is the low tax jurisdiction, whereas country B is the high tax jurisdiction. Now with this kind of a situation, now the question is that how this was sought to be addressed by the OECD when OECD and other stakeholders, they saw that this is the problem, then how this was sought to be addressed. The answer to that was the BEPS Action Plan. So the genesis of BEPS Action Plan was this, that the M&Es were claiming excessive deduction of interest and getting a favorable tax position. Okay, so with that said, now let us move and look at what are the areas which are dealt with that problem statement, which we saw in the last two slides. What areas are dealt with by OECD's BEPS Action Plan 4? Now, essentially, BEPS Action Plan 4 by the Organization of Economic Cooperation and Development, OECD, this Action Plan 4 essentially deals with the three scenarios by which base erosion can possibly be achieved by M&E groups. What are these? This is what is listed below. As we saw, the similar chart is something which I brought forward here. So the first scenario is high level of third-party debt in high tax jurisdiction. You have disproportionate amount of debt giving you tax deduction. That is one scenario in which base erosion can happen. Secondly, using the intra-group loans to generate interest deduction in excess of the group's actual third-party interest. The example which I gave. On the 100 rupee borrowing, you pay 6 rupees, but you claim deduction from a group perspective 12 rupees. So, in excess of your actual interest expense to third party is only 6 rupees, but you are actually getting deduction of 12 rupees. This is the second scenario. Using intra-group loans to generate interest deduction of 12 rupees in excess of group's actual third-party interest of 6 rupees only. And using both, a combination of both the third-party and intra-group financing also to achieve similar objective. Right? So therefore, with this problem statement, the BEPS Action Plan 4 seeks to achieve these things. So, with this problem fully understood, the OECD sought to develop recommendations which will have the design of the domestic rules. It will recommend how the domestic tax rules should be designed, which prevents this kind of base erosion happening in these high-tax jurisdictions. And how will that be done? This prevention of this tax-based erosion through the use of interest expense and other financial payments that are economically equivalent to interest. So basically, interest or something which is quasi-interest, if gets deductible in that jurisdiction, it gives you a favorable tax position. So basically, BEPS Action Plan 4 seeks to develop rules or seeks to recommend rules so that the various countries can use those rules, to their domestic tax laws and prevent such kind of a base erosion situations. Right? So what BEPS Action Plan 4 recommended to address this issue, that is something which we will look at in the next section of our deliberation. There are a specific recommendation which were given by OECD as part of the recommendation for your BEPS Action Plan 4. So what were the key recommendations and requirements under the BEPS Action Plan 4? Let us see this. So to prevent the erosion of tax base on account of interest deduction, in year 2015, so in 2015, the BEPS Action Plan report established a common approach which directly links the net interest deduction to the level of activity of the entity in a particular jurisdiction. What does it mean? It simply means that under 2015 recommendation by the OECD, it said, okay, let us develop a common approach. Now, when it comes to interest deduction, let us follow this common approach, and I'll explain what are the contours of this common approach. But it said, let us follow a common approach, and in that approach, the quantum of interest deduction available in any country should be linked to the level of economic activity which is happening in that particular jurisdiction. And how would you come to what is the level of economic activity? Say, represented by EBITDA in each of these countries. So therefore, the 2015 recommendations by OECD, when they recommended the common approach, it directly links the deduction of the interest expense to the level of EBITDA in respective countries. And to achieve this, what they did, this common approach, which I just explained, this common approach had 4 various elements. What are the elements? Let us see one by one. The first element was what is called fixed ratio rule, FRR, fixed ratio rule. So what the OECD says? OECD said because your interest deduction has to be linked with the level of EBITDA in the particular jurisdiction, this rule, the fixed ratio rule, says that the interest deduction is allowed. Interest deduction in any particular jurisdiction is allowed on the basis of the interest expense to EBITDA ratio in each country. So therefore, if you have 2 countries, country A and country B, what you need to do? basically the interest deductibility in country A and country B should be on the basis of interest expense as a percentage of EBITDA. And this percentage can be determined by each country. So for example, country A says that in my jurisdiction, this ratio should not be more than 30%. Country B says it should not be more than 20%. So that is something which is allowed. What this BEPS Action Plan said, that in the range of 10% to 30%, sometimes colloquially called as 10 to 30% corridor. So the recommendation was that countries can develop what is called the fixed ratio rule, and there they can apply the corridor of 10% to 13%. Second element of this common approach was group ratio rule, GRR, group ratio rule. What it means? This group ratio rule was intended to supplement this fixed ratio rule, right? And I'll explain this one more time in the next slide also. But this ratio, this GRR, the group ratio rule, was intended to supplement the fixed ratio rule, and it was intended to provide additional flexibility, especially to those groups, those industries which are highly leveraged, where historically the requirement of debt is significantly more compared to other industries. And the third element or the pillar of this common approach was a combined approach. Now, what is combined approach? Basically, is a combination of these two approaches collectively. So in combined approach, fixed ratio rule can be supplemented. This rule can be supplemented by a worldwide group ratio rule, which allow interest deduction up to the group's net interest to EBITDA ratio. Now in this, the interest deductibility was on the basis of this ratio for each legal entity. Whereas in combined approach, rather than applying the ratio of the entity in a particular jurisdiction, the maximum permissible deduction for the interest is on the basis of the group's interest to EBITDA ratio rather than the legal entity's interest to EBITDA ratio. And the fourth pillar of this particular common approach was certain targeted rules so that the MNEs do not deviate from these rules by some kind of an unethical practice. Also, there were talk about that industries like banking and insurance sectors, companies in this sector should be exempted from this because they have a different kind of a environment in which they work. Their industry or their business environment is different, and therefore there should be specific rules which apply to banking and insurance sector. General rule should not apply to them. That is the sum and substance of the common approach, and therefore this Action Plan 4 seeks to prevent MNEs from eroding the tax base of a particular country by claiming excessive tax deduction and thereby shifting profits to low tax or no tax jurisdiction. As I gave an example, that shifting the profit from country B to country A, that is something which was sought to be prevented by this Action Plan 4. Now let us deep dive into these four pillars of the common approach. One more slide here. So if you see here, the primary rule under BEPS Pillar 4, Action Plan 4 was, as I said, the fixed ratio rule. So as I said, this is the primary rule, and interest deduction by applying this rule is interest deduction in each jurisdiction is allowed on the basis of net interest to EBITDA ratio of the entity concerned, not the group, in the corridor of 10% to 30%. And the countries are free to determine what do they set the ratio. Should it be 10%, 15%, 20%? But in the range of 10 to 30% was the recommendation by OECD as part of this common approach. And therefore, this approach is based on benchmark, the benchmark of that between 10 to 30%, whatever is agreed, benchmark net interest to EBITDA ratio, and limits the interest deduction to a fixed percentage. Now that percentage between this range as determined by each country. So fixed percentage of EBITDA in a particular territory or a country as decided by each country. This is your fixed ratio rule. Now, the group ratio rule and combined rule, let's read it together. This basically, as I said, under this approach, the interest deduction under the group ratio rule will be allowed on the basis of interest expense to on the third party debt as a percentage of EBITDA, but not of the entity, but for the entire group. That is how you will apply the group ratio rule. And therefore, in this approach, interest deduction for the entire group is limited to overall third-party interest expense, which has been incurred by the group, and therefore the interest expense is allocated to an entity should match the economic activity by that entity represented by EBITDA or the taxable income, okay, of the various entities in the group. Accordingly, this approach ensures that the entity's net interest deduction is directly linked to the taxable income or EBITDA, as we discussed, generated by its economic activity in each of the respective jurisdiction. So, as I said, these rules are sought to be supplement to the primary rule of fixed ratio rule and is intended to provide additional flexibility to highly leveraged industry or the companies. But having said that, this group ratio rule is not something which is mandated. So therefore, a country may choose not to introduce group ratio rule at all. That means a country may choose to apply only this rule. These may not be applicable. That is, so of course the recommendation was there, but the countries were free to choose which direction they want to go for. And then targeted rule, as I just said, they address specific risks and are intended to support the general interest limitation, what we discussed here, that they support. These rules expect that the country should consider rules to prevent avoidance or manipulation of the other two rules. As I said, these are something which are targeted rules to make sure that the MNEs do not flout these rules, right? That is the whole objective of these targeted rules. So this is the edifice of entire BEPS Action Plan 4, and how the recommendations were done. Now, some of the other recommendations which were also given as part of this Action Plan 4 is on something called as the de minimis threshold. What does it mean? It says that, okay, you apply the general rule, but this de minimis threshold will permit that a country may decide that, okay, up to a specific monetary limit, say 1 crore rupees of the total, as an example, I'm saying 1 crore rupees of the total interest expense. So if you have entities which do not have significant absolute amount of interest expense, so you can give this kind of a exemption that these rules do not apply to them. So therefore, the recommendation in BEPS Action Plan 4 was that the countries can employ what is called a de minimis, a minimum monetary threshold. But of course, this recommendation was also an optional one, wherein they said that an optional de minimis monetary threshold can also be implemented by various countries. Therefore, because of that, the entities with low level of net interest, in my example, say up to 1 crore rupees of the total interest in a year, they will be carved out from the general rule related to interest limitation. And that will, if you go for this particular de minimis threshold, something like this, then it will help in the sense that the low risk entities which do not have significant amount of interest expense in an absolute manner, okay, they will be eliminated from the scope of applying these interest limitation expenses rules, and that will remove a lot of compliance burden on such companies. So this was more of making life easy for the corporates, relatively smaller organizations which do not have large exposure to interest expenses. And also, the BEPS Action Plan 4 also recommended about the carry forward. So for example, let us say by applying the interest limitation, an entity initially incurred a cost of 6 crore rupees of the total interest expense. Now, if you apply, let us say, the fixed ratio rule and only 2 crore is allowed, then the balance 4 crore should be disallowed. Now, what OECD says, okay, this 4 crore which is disallowed can also be allowed to be carried forward by entities. So the tax rules of each entity or each country, not each entity, each country can allow for the carry forward of the disallowed interest, in my example, of 4 crore rupees, so that this 4 crore can potentially be offset in subsequent future period subject to meeting certain conditions. So these were additional considerations or recommendations which were given by OECD as part of this Action Plan 4. Now, all of these, what we discussed so far, was part of 2015 version of the recommendation of Action Plan 4. Now, in 1 year later, in 2016, this recommendation was slightly updated to give more teeth to what was already recommended in 2015. So, the 2016 updated version of the Action Plan 4 recommendation provided additional guidance related to these two areas. What are the areas for which additional guidance were given? How to design and operate the group ratio rule, and how to deal with the particular risks which are posed by special sectors, industries, or the companies in the banking and insurance sector. So those were additional guidance which are given in the 2016 version of the Action Plan 4 report. But interestingly, whatever was already concluded in 2015, that was not changed. And that is what the next point is, that the updated 2016 report, it does not change any of the conclusions that was already reached in year 2015 in this report and the last couple of slides what we discussed today. None of these conclusions were changed or overruled by 2016 report. All this 2016 report did is that it provided additional guidances on areas like this, right? It only provided additional layer of technical details to assist countries in the implementation of the group ratio rule in line with the common approach which was already laid out in year 2015. That is what 2016, the report basically did. And therefore, OECD also recommended implementing anti-avoidance rules. Like what we said, the special precaution need to be taken to prevent that MNEs circumvent the interest deduction limits through, let us say, doing complex organizational structuring or by artificially inflating EBITDA figures. Now, this is what from a theoretical framework, what this BEPS Action Plan was all about, Action Plan 4 was all about, how it got originated, what are the key recommendations and the requirements which OECD suggested in 2015 and 2016. We will continue our deliberation on this in the next video, wherein I will give you case studies. I will actually have 3-4 case studies to explain each of these rules, your fixed ratio rule, the group ratio rules, and how these rules interplay with each other. I will give you comprehensive case studies, and we will then conclude our deliberation on this BEPS Action Plan 4. So this is what I wanted to cover for this video. Please be on a lookout for the next video, which will cover the case studies. These are some of my contact details. This is the link for my YouTube channel and this one for LinkedIn. Please connect with me and subscribe to the channel, comment, share, whatever you want to, whichever way you can help the channel, that'll be very helpful. Put comments so that I know whether you are able to, like these kind of the content which I'm uploading in the last three months or so. Okay, so I will just look forward to your continued patronage, and we will continue to do this kind of a deep dive, various kind of videos on various areas. Okay, bye for now for this particular video. Take care. Bye. Thanks.